Hi Mortgage Heroes, Brian Landeros here, loan officer, and this is Monday Mortgage Minute. Remember last week when Andy said there was two really big things happening? Jerome Powell and jobs. First off, Jerome Powell testified in front of the Senate Banking Committee Tuesday, March 7th and Wednesday, March 8th. He pretty much sounded like he was reading off the same set of notes from the last Fed press. He said things like, we will have to hold rates higher than initially expected for longer than expected and sustain them until we see inflation return to the 2% target. I mean, how many months in a row is this going to continue? I get it. They're not making traction in the ways they need to, and he's not going to reveal any new secrets prior to the meeting coming up next week. But man, the repeated canned commentary is just not helping inspire confidence that we're heading in the right direction. Second was labor and jobs. JOLTS continues to be bipolar month after month. North of 11 million one month, then below 11 million the next month, then north of 11 million again, and back below 11 million. In my opinion, it's way too unpredictable to continue as a major variable in the Fed policy moving forward. But what do I know? Maybe they have a job opening coming up. ADP non-farm payroll came in super hot, well above the forecast and even the previous month's number. So even though we want there to be more job growth like this indicating, the Fed wants more unemployment in order to squash the demand so that people will stop spending money at these elevated levels. It's the only way inflation has a chance at returning to their target. Unemployment was higher than expected. Again, this reading has the Fed's attention as it relates to the future because of the aforementioned demand destruction strategy. Average hourly earnings were worse than expected, but what's most important is the long-term readings compared to inflation. If hourly pay can keep up with the elevated costs, then problems for the Fed persist as wage earners are able to cope with sustained higher prices. This week, the most important thing happening are all coming at us like a fire hose. This is the week before the next big Fed meeting and the rate announcement, so this data will be considered vital leading up to March 22nd Fed rate announcement. Tuesday starts us off with month-over-month CPI, year-over-year CPI, and the Fed's favorite, core CPI. Wednesday, we get month-over-month PPI, month-over-month core PPI, month-over-month core retail sales, and month-over-month retail sales. But wait, how could there be more? The Empire State Manufacturing Index also comes out, which we thought wasn't a big deal last month, but turned out to be a really bad sign for the market. Wednesday is a big one. Thursday, we're watching building permits, and housing starts closely hoping for positive readings in both of those. Unemployment also comes out and has been pretty erratic lately, and it's contrast with what the Fed wants to see happening. Finally, Friday, we have preliminary consumer sentiment and the preliminary inflation expectation readings. It sure would be nice for both of these to reflect some sort of positivity coming into the week before the Fed rate announcement. The markets and the economy at large could use some good news right about now. So what does this all mean for mortgage rates, Brian? You could expect mortgage rates to be flying all over the place this week. With so much data coming out and it being the week before the big Fed announcement, you should not expect this week to be smooth sailing. Weeks like this are where your communication, your preparation, and the execution all work in your favor. If you have a lock on your loan this week, you should really stick real close to your loan officer and be ready to strike if and when the rates take a midday nosedive. Remember to subscribe, check out Mortgage Heroes podcast on YouTube, Apple, Google Podcasts, and thanks again for tuning into Monday Mortgage Minute. We'll see you again next week.